Yeah. Two. Yeah. Aye.
Yacht over money.
I'm jacking the beat, you calling the cops. The yapping is cheap, I call you the ops. The rapping is hating, it's all cause of pop. You get a leak for the ball, get a drop. Feel like I'm wrong when I double it back, cause I'm making it harder to catch that. But I covered the ticket, I call you to visit. You tipping and hit up the cash app. Baby girl, been around for it. Yeah, in the old days, I was stuck in old ways. Never really trying to flip the old page. Young man tripping at an old age. Thinking I was flicking, had a low wage. Led the bro days, then a slow praise. Thinking it'd be different, it would gon' change. Then it really didn't, it's a cold game. Yeah, hey, all I really wanted was the money in the pocket. Got over money, but the money ain't the topic. Like Bill Doe and the money gotta stop it. Kid need food and the whip need juice. I'ma get these views when the
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, baby? It's your partner Dale and Cliff back in the saddle again, guys, for another, or this is the last Roasted Live in the year of 2023. Cliff, man, this has been a pretty good year, man. How about your partner, man? How was the week, man? How was the year, Doc? How was it? Let everybody know what's going on. What's going on, baby?
Man, it's been crazy. 2023 was wild. You've been following the finances, following the real estate. I mean, we started off 2023 hot. Everything was going good. We had somewhat of a normal market, just fell off. Bad market, man. So it's been crazy with the interest rates, but I'm ending this year strong. Man, it's been doing good last couple of weeks. Got a couple of properties under contract, so we move in the right direction. Man, I'm thinking the way we headed 2024 looking real good, man. So I'm happy with it, man, and so I'm looking forward to this next year, the next opportunity, man. So can't complain, man. What's your situation like?
Same thing, man. Just dealing with what I call, man. It's been a good year. I've had to learn how to adjust off the fly because, as you know, Cliff, this year has been a year of surprises because of what's going on economically, which is fine. But at the exact same time, being able to have the wisdom to pivot off the cuff, that has been the secret sauce to our success, so to speak.
Mhm.
And so we're going to continue to do that, guys. In other words, me and Cliff, we've actually pulled out of deals, to be honest with you, because the deals just didn't make any sense at all. That's what me and Cliff actually did, man. Is that right, Cliff, man? What do you think, brother?
Yeah, I mean that's part of the process, man. So we had some deals that didn't make any sense, especially when you start looking at the market that we going in. It's just not worth the risk. So yeah, we had to. If it don't smell good, man, don't eat it.
Yes, sir. If it ain't written, it ain't real. We don't like it, so we ain't gonna do it. But guys, let's dive into this. This is the last Real Estate Live of 2023, so let's make it a good one. Let's dive into the current market analysis. You know, we do it every single time because we're in a changing economy and things change from week to week. So, Cliff, I'll give it from an investor standpoint and a lending standpoint, a private equity standpoint, from a GC and investor as well as a licensed appraisal. What are you seeing in the market right now from lower level, price point, mid, and also luxury?
So all right, we're gonna start with luxury. Luxury's falling. So if you're looking to get a luxury house, I would say now's the time. I mean, just because you got to realize the interest rates went up and they doubled for 400,000.
It did.
So think of it as on 1.5 million, 2 million. That price point already was high. Now it's even higher. So it's hitting luxury hard. Luxury's falling hard. The mid-tier market is just staying sideways.
Yes.
It's not really moving. I see a little cracks in certain areas where it's coming down a little bit, but there's no inventory. Now the low end, still strong. It's not, it's still going up slower, right? It's going up slower, but the offers are still there.
Yeah.
That's the market I love. I love below medium price, them cheap properties. That's my bread and butter, man. I know them properties well. So that market's almost always selling. Always.
Mm-hmm. It is. It is. That makes some sense from a lending standpoint and a private equity standpoint, JV standpoint. What I'm kind of seeing in the market is you have it kind of mimics exactly what Cliff has talked about. That 300,000 and below, 400,000 below, it's always going to be hot because people. It didn't cost people that much money to go out and get a loan. Now the interest rate may be higher, but it's not that big of a push at that level from a monthly payment standpoint. 400,000 and above, yeah, you got to make some decisions. The luxury market is, man, I agree with Cliff, man. If you want to buy a luxurious home right now, this would be down. Now would be the time because of the fact that those have long days on market. No one's running after those deals at all. They're not. They're not, guys. It has just been a very interesting market, even on the commercial side. That commercial side, apartment complexes, that's a great investment as well. We typically focus on the B minus, B plus to C minus because we want to acquire properties below wholesale, increase the value, make them B minus, B plus, depending on what we buy as far as class wise. And then what we typically do is we then go to long-term debt and cash flow them to Jesus come back. So that market has always been strong. I don't do the. I'm a big Grant Cardone fan, but I don't target Class A assets right now at all because to me it doesn't make any sense. I agree with his model, but for me it doesn't make any sense for me to do that at all. Cliff, you agree, Cliff?
Yeah, that's just not. I mean, that's a whole different direction to go. That's more of a raising capital. He focuses mostly on raising capital because he's buying basically properties that can run themselves. That's
exactly
really what he's doing. So, no, I'm focused on the market that's always going to be there.
Exactly, I agree with that 100%, man. Well, let's dive into this real quickly, guys. We actually got a lot of chatter on our last, and it's good comments on our last Real Estate Live last week because we talked about the Fed rate cut and what may be the reaction to a potential Fed rate cut. Cliff has been on the record to say that there's going to be several rate cuts in the next 18 months, right? Number one, because it's election year. Number two, that's really trying to control the market. It's a PR stunt is what it is. And so I was actually kind of perusing a little bit on social media, really on YouTube, as I was kind of working a little bit, doing some admin stuff as well. And I ran into a video about a trusted source, and he actually had a interesting take. His question was, will a rate cut trigger a 2007-like market crash? And I just said, woo, but the evidence that he presented was very compelling. So I said, you know what? Let me go ahead and bring Cliff on, allow for everybody on all the live screen, on all the platforms to chime in as well and give us your thoughts, guys. So let's see what he has to say. Again, we've used his content in the past, guys, so this is nothing new. But at the exact same time, this gentleman, I like his content because what he does a lot of the times is he actually has a lot of details backing it up. So this is not something that he's doing off the cuff. This is some good information. So let's see what he says, and Cliff and I will react real time, and you guys react as well. Here we go.
Federal Reserve just threw the economy and housing market for a massive loop by predicting interest rate cuts in 2024, projecting 3 cuts in interest rates down to a federal funds rate of 4.6%. And these new projections from the Federal Reserve have caused the markets to go crazy, with long-term bond yields and mortgage rates plummeting and the stock market surging. However, what everyone seems to be missing, and what you need to pay attention to, is the fact that Federal Reserve interest rate cuts are rarely positive indicators for the economy.
Oh.
Rather, they tend to directly precede massive spikes in the unemployment rate. Every time the unemployment rate has increased over the last 70 years, the Federal Reserve cut interest rates right before. We've seen this all before, everyone. We've seen this type of euphoria right before things get really bad in the economy. And to see what I'm talking about, let's go back to September 2007. 1 year.
So Cliff, but before he goes into that soliloquy, off the cuff, do you from the beginning do you agree with his initial premise?
No.
Really?
I mean, so I'll say this: some parts of it I agree with, but so I don't think there's going to be a crash. No, we have too much liquidity in the system, right? There's too much money. It's kind of hard to have a crash when there's too much money.
Yeah, I agree.
So that's not it. There's trillions sitting on the sideline. All these big businesses, they're sitting on cash. So
Sure.
I don't see a crash. Now, do I think unemployment rate can go up? Yes, it's already trending that way. Unemployment rate is going to go up when you have a decrease in demand.
Okay.
That's what the Fed is trying to do. They're making stuff more expensive to reduce demand, right? So if demand's reducing, we don't need as many employees because we're not doing as many sales.
So what you effectively are saying is one of the jobs of the Federal Reserve is to drive unemployment up.
No, it's to drive it down. But
Drive it down.
so the unemployment rate is going to go up, but it's going to go up, level out, and start coming down. It's going to follow the Fed rate cuts.
I'm rocking with you, but if the Fed is so now I'm talking about it going up now as far as is the Fed adjusting the rates up? They're adjusting the rates up because there's too much fake liquidity in the system, right?
Right. Yep.
Which is cause for the cost of goods and services to go up as well, right?
Right.
Now, what's happening is by doing that, if the cost of goods is going up, that affects also the producers of those goods and services as well, right? So that means their cost to do business goes up, right?
Right.
Which affects their bottom line. Now, does a well-oiled machine business, are they in the business of continuing to pay for goods and services, to produce those goods and services, to pay more for them or less for them?
Oh, they're always trying to reduce their expenses as
So
much as they can.
isn't one of the expenses to a business also the employees as well?
Right. Yep.
So if the cost of goods is going up and services is going up, and it's beginning to cause a conflict with the bottom line, my question is just here: if that's actually happening, wouldn't it also cause for potential layoffs?
Yeah, that's what, and unemployment will go up. So, but you got to understand why are they doing that? They're doing that because of lack of demand. Why is there a lack of demand?
Okay.
Because the interest rates are high.
Yes.
So let's reverse that. If interest rates weren't high,
Okay.
what would they be doing?
They wouldn't be doing anything at all.
Right. They wouldn't be laying off jobs. So at the current interest rates, they're high. Current interest rates are high. While they're still high, unemployment rate will continue to go up. Once they start cutting interest rates, they're going to cease laying off people, and you're going to get a more normalized market.
So what you're saying is with these rate cuts, that's going to trigger these big companies to not lay off any additional people and maybe even hire more people. Is that right?
Right. Because now the money is getting cheaper.
Now let's go a little deeper there, guys. Just go a little deeper there, guys. If that's the case, then Cliff, then there are consequences to what the Fed is doing from a consumer standpoint. Let's go into the consumer seat now. The consumers are now, their credit card debt is at $1.4 trillion, the highest in history, because they manufactured a pay raise because their employer could not provide that pay raise, right? Because the cost of goods are up, right?
Yep.
So if what you're saying is correct and they begin to cut rates and the employer begins to say, okay, now we can begin to hire more people on, well, now they got a problem now because now the consumer or the worker is costing them more to live because they had to manufacture a pay raise because of credit card debt. Now they may have to pay that person more money to get the same service. Would that be logical to conclude?
Yeah. So yeah, service costs are going to continue to go up. That's one part of the inflation. So ain't no doubt that
So if
cost is going up.
so if that is the case, though, the companies are still in the same boat. Their expenses are continuing to go up in one segment of their business model, service.
Yeah, that will continue. That will continue to go up. That will continue to go up. But you're going to see more. You're going to see people. You're going to see divestment, right? You're going to see them invest less in services as we continue to grow. So basically, at the end of the day, what I'm talking about is they talk about a hard landing, soft landing, right?
Okay.
I'm in the more soft landing than I am the other one.
Okay.
I think it's more likely you're going to see unemployment go up, level off. The same way you're going to see inflation the way it did go up, level off. They're all going to level off. The point of the Fed is trying to do is they're trying to bring us back to a point where they can inflate the way we were before. We are an inflationary market. We've been in that way for 50 years. We're trying to get back to a place where we can continue to do that at a 3% rate.
But the only way that actually happens, Cliff, is if they lie to us by massaging the numbers. Oh, what happens?
I mean, the whole market is already artificial. We just playing the game. That's what I'm talking about. I'm talking about we just playing the game.
Oh, this is, guys, we got a question real fast by the White Box. He said, how long will it last? If you could, what do you mean by how long will what last for you? The White School Podcast. Let us know what the it is in your question so we can actually address it if you don't mind. So we understand this is a smoke and mirrors type of scenario, but the exact same time is a lot of the consumers don't see this or they can't fathom this at all, and that's okay. The question that I'm saying is this here is if the only way that we can get down to this 2 or 3% inflationary rate actually happens is if we massage the numbers. That's a big old fat lie. Here's the question though. She said this here. She said, how long would it last? She said, It says the taper off that Cliff mentioned. So how long would it last, Cliff?
So I mean, once we're gonna see it continue to go the direction it's going for probably another 3 months, longest 6 months. Then you're gonna see the Fed step in and start cut rates in that 3 to 6 month window. Right now, if you go look at JP Morgan, you go look at Goldman Sachs, they're already predicting they're going to cut in May or April or May. So I'm right in that same camp that they're going to cut because we can't keep this price up. You can't get a car.
I agree.
You can't get a house. They have to cut.
I agree with the cutting. I'm talking about the effects of the cutting.
The market's going to go up. Remember, I told you before, if y'all was paying attention, I told you when to jump into Zillow, and I showed you y'all could have made about 7% in a week, showed you Redfin, that it's going to continue to go up. So next year, I'm predicting anywhere from 10 to 15% in the S&P.
Gotcha. Now, when it goes up, guys, that's going to be another fake event.
The whole system fake. Like we don't talk about fake. You know what I'm saying? You know that.
I'm rocking with you. But we gotta let people know what's going down, man. Hey, y'all, This is gonna be another fake event, guys. But let's see let's see what he actually presents, and then you and I will respond to this as well. Because this is a great conversation. Here we go, guys. Here we go.
Year before Lehman Brothers. What happened in September 2007? That was 1 month after the Federal Reserve first cut interest rates in that new cycle. So the Fed had just cut interest rates in September 2007, and that initial rate cut caused euphoria all over the stock market. Take a look at this article from back then. From September 18th, 2007, stocks surge on the Fed interest rate cut. The Dow Jones Industrial jumped 2.5%. The S&P gained 3%. The Russell 2000 gained 4%. As the market reaction suggested, hallelujah, the decision to cut interest rates seemed to reassure investors back in 2007 that the central bank will do what it can to keep liquidity flowing and to protect the economy from falling into recession. So folks, back in September 2007, people were thinking the exact same thing that they're thinking right now. And that is
Cliff, you agree?
No, because the situation,
Oh,
it's a
okay.
different situation.
Okay, how's it different?
We have too much money in the system. In 2007, we are getting ready for a problem where the market was juiced in the real estate market. We had a lot of mortgages that were on adjustable rate mortgages, right? The people were doing them 3-5 year arms.
Yeah.
You know, the problem wasn't we didn't just pump $2 trillion in the market. So, okay, let's look at it this way, right? We spent how much money, Dale, in the last 2 years, last 2-3 years? We spent like a couple trillion, like
Okay,
two
yeah,
trillion,
okay,
right?
okay.
Yeah, where'd it go?
Good question. I
Where
believe
all
that it
that? That's a
actually.
lot of money, Dale. Where'd it go?
I believe where the money flow to is for those that are actually positioned the right way. For those that are positioned the right way in the market, the money flowed to them. That's why it's called a currency. The key word of currency is current. Current flows. That's why when he said 2007, he was pointing to where you're correct. There was a lot of money pumped into the system. That's how people bought all those properties. That's how they're able to borrow all of that money. It's the same scenario. There's too much money in the system. It's the same. It's the same construct, right?
Right.
Same construct. So let's see what he says about this as well. Because he said 2007, right? Let's see what he says. Here we go.
has got to scare you. The delusion going on right now in financial markets is eerily reminiscent of something we saw just 15 to 16 years ago, 1 year before the shoe dropped on the economy. It was 1 year later, the unemployment rate spiked, and then Lehman Brothers occurred, and then it became obvious that we were in a massive downturn. And of course, history isn't guaranteed to repeat itself. Everyone. Theoretically, the economy could have a soft landing in 2024. Stock prices could keep going up. Home prices could keep going up. However, when I look at the data, I just don't see how that's possible. Because we have a US consumer that is saving almost no money right now. An average savings rate of 3.8%, near the lowest level on record. So consumers are extremely stretched, ready to tap out. At the same time, the debt levels in the economy are absolutely absurd. Total debt in America has reached $73 trillion between the US government, consumer households, and corporations. That $73 trillion in debt has doubled from what it was only 10 to 12 years ago. And it's now at 265% of GDP. By far the biggest debt load our economy has ever held. And so even if the Federal Reserve cuts interest rates 3 times next year, or even if they cut rates 6 times next year, I don't think it's going to matter too much, because either way, people and businesses are going to continue to refinance that debt at higher interest rates than they had before, and those higher borrowing costs are going to start to slowly and incrementally choke off economic activity in the economy.
Exactly. This is why this was so appealing to me, Cliff, is because he's factored in the borrowing power of the consumer. The consumer's borrowing power is going down. It's going down. And so if the goal is for the money to continue to flow, right, a big portion of money flowing is the consumer. The consumer right now is cash up right now because they owe more money than they're paying more money is going out than coming in. So how is the consumer going to be a part of that currency flow?
Once interest rates drop. If interest rates drop, the credit card drops. The credit card payment that they're paying 25% drops to 18%. The house that's paying 6% starts dropping to 5%. Right? The loans they got.
So you mean to tell me the credit card companies, they're going to voluntarily drop those rates?
If they want to be competitive, they're going to have to. The big boys always drop the slowest. Amex and stuff, they can hold out.
I'm rocking with you. I'm talking about money that's already owed on the credit cards. Not borrowing new debt. Cards that are already borrowed. I have never seen a credit card company, not saying that they can't. I've never seen the credit card company drop those rates on debt already owed. Specifically if it's maxed out.
They can if you basically what's going to happen is, like most stuff, it gets refinanced away. In America, debt is not held that long. If you go look at what's the trend of how long someone holds credit card debt, it may be high, but what's the length they average hold it? Is it 3 months, 6 months? So that tells you that interest rate they're at is going to eventually get refinanced at some point. Once interest rates drop, that becomes easier to do, right? So basically, if you're worried about debt, then you're missing what's going on with the way our system works. We have a debt system. Debt is how do we get from, you got a nice car, you want another nice car. How you get there? Debt. You got a house. How you want another nice house? Debt. That's how our whole system works. So if there's more debt, that means there's more dollars. That means that's going to keep growing.
I'm not refuting anything that you're saying from a economic standpoint. The hole that I actually see in your presentation is the consumer part. The consumer is paying more for just the living, and on top of that, they have credit card that they have to pay now. Right? Now you're saying that the credit card companies are going to take the rate down from 25% to 18%. I'm like, huh? I've never seen a credit card company do it on debt that's already owed, that's maxed out. They're killing the game making all this money. Why, if I am a credit card company, if Clip is paying me 25% interest on debt, why would I, and you max it out, why would I reward you by lowering your rate from 25% to 18%?
Not your current. It's just like a house. Your mortgage. If you got someone got a house this year and got an 8% mortgage. Somebody.
Okay. Of course.
So when interest rates go to 5.5, they still owe how much it is, $500,000. They still owe it.
Yeah.
But I'm guessing they're going to refinance at some point as soon as they can. As soon as they got the opportunity, they're going to refinance that debt. And the average debt is refinanced fairly quickly. That's why on a 30-year mortgage, what do you look at in terms of the bond? Look at the 10-year bond.
Yeah.
Because we don't do 30-year. We refinance debt. That's what we do.
I got you. So are you saying that people that actually have 2 or 3% interest rates on their mortgages for the homestead homes are going to graduate up to a 6% interest rate?
No. So when it comes over to the people who already have low interest rate, what's going to end up happening is you're going to have a slowdown effect there. They're not going to sell as quickly. So you're going to have an inventory problem. Not as many houses will hit the market.
Agree with that.
Which is going to cause there to be high demand because of low interest rates, but low inventory. So you're going to see housing go up.
So I'm rocking with you, but what I'm saying is here is the flaw that I see in that thinking.
Okay.
It is, I think that presentation is really focused on the consumer being able to actively be a part of the currency flow of money. And what I'm saying is because of what has happened with the raising of interest rates, and then the counter move to that of the consumer of borrowing more credit card debt, right? You begin to see that the middle class is not going to be as active as people actually think, because they can't, because there's not enough cash coming in, because it's going out faster than it's coming in. Does that make sense?
I see what you're saying. So you think there's going to be a decline next year, that the market is going to go down?
I believe that's a big chance that it may do that, because the Fed is banking on the consumers actively being involved in the currency flowing of liquidity process. And what I'm saying is, in a normal type of decline, like in 2007, so to speak, I can understand that, right? But this is a different beast, because in 2007, it was only centralized on the real estate side, right? And maybe a little bit on the insurance side. This one, it's in every industry. And you have a lot of record amount of repos going when it comes to cars. Now, people are 3, 4, 5 payments behind on their car payments now. So I'm like, not only do you have credit card that you're better paying, you can't pay for your car payment right now as well, also because of the interest rate right now, what's going on, because the cost of goods, the cost of living has gone up so much, the consumer is tapped out.
I see what you're saying. I think you're right so remember how I said I don't see it getting cuts for the maybe next 6 months, right? Maybe 3 to 6 months, right?
Okay.
So what you're talking about, I think, is what's going to happen in the first couple of months, where
Mm-hmm.
interest rates are still high
Mm-hmm.
and unemployment rate is still high. So
Yes.
then things are going to continue to squeeze. The Fed is going to recognize that problem and start cutting to ease that issue, juicing the market and continuing to juice the market for the foreseeable future.
And what I'm saying is, I agree that the Fed is going to do that. I'm agreeing with you. They'll do that. No problem with it at all. My counter argument to that is, what will the consumer do that's already tapped out? They're already tapped out. They have nothing in savings, zero in savings, and they owe a huge amount of debt when it comes to a mortgage, car payment, and credit card debt. How are they going to participate in that flowing of the dollar? Where's the money going to come from?
It's not going to come from anywhere in the beginning. Once they cut interest rates, because if you're let's say you're the CEO of a big company,
Okay, holla at me.
McDonald's or Walgreens or something like that, right?
Yeah,
Big
yeah,
multinational company.
For sure.
You want to expand, you want to do things, you need billions of dollars you need to refi at. And you got some
I
debt.
got you. I got you.
Right now, you go to the bank, you go to Bank of America, they're telling you 7.5 interest rate. You're like, no, we're seeing a slowdown in our revenue. We're seeing a slowdown here a little bit.
Sure.
6 months goes by, Fed cuts rates.
Yeah.
You go back to Bank of America, you say, hey, I need to borrow that money again. I need a couple billion to expand, do some updates. They're going to say, yeah, the rate's now 5.5. Now it looks better. That billions gets put back into the economy.
Okay.
Because everything flows from the top. We all work for the rich. Where do you think the money's coming from? It's coming from the rich. So when the rich have more money, they spend more money, all that.
So what you're saying is, because the producer, right, not the consumer, but the producer is able to borrow at a discounted rate because of what the Fed is doing, that's going to alleviately affect the consumer in what manner?
Because it's if your employer has more access to cheap capital, they have the ability to expand and they have the ability to keep you on for the expansion. So what ends up happening is the unemployment rate's been going up. That's part of the squeeze.
Okay.
When unemployment rate goes sideways or even down, that's a sign. If unemployment rate is going down, that means there's more jobs coming into the market.
I'm rocking with you, but what I'm saying is, there's more jobs at what pay scale, because now you have a producer who's been paying higher for their same goods. Now they're paying a little bit lower. How they're going to invest those dollars? Are they going to invest those dollars into paying more salaries to these new employees now, or are they going to ask for their current employees to take a pay cut? Because they have to make up that deficiency that they actually had for the last 3 years.
So we had inflation, right? We had too much money in the system. Like we talked about. If the Fed did not raise interest rates, what would have happened?
It would have tanked the market.
The inflation would have just kept going, right?
Yes,
kept going. So that means that same amount of capital to inflate is still in the system. We just artificially capped it.
I agree.
So when they cut rates, they're going to tap back into that market. So you're going to see what happened during the past during the pandemic is we saw unemployment hit all-time lows.
Yeah.
Right, because the money was flying. Inflation was going up.
Yeah.
We're going to go right back to that, but at a slower pace. It's the same thing. We just go in there at a slower pace.
This is where you and I disagree on. I think that I see your point, right? But I think that what you and I disagree on is this here. Is in what you are presenting, although it's informative, it is the foundation on your projection being successful is a positive response from the consumer. Because the consumer right now is tapped right now. They're tapped. It's like they're in the UFC ring right now about to tap out. And what you're saying is you're saying that in comes the Fed, they cut the rates, which allows for companies to borrow debt at a cheaper interest rate, which is great. And what you're saying is now you have another entity, which is the producer. They are going to decide to either pay these consumers more to leave it that gap or hire more people on. I know what I would do is I would look to how can I more efficiently run my company to where I can increase my bottom line by delegating those responsibilities to less people. In other words, if I can have Cliff do three things instead of hiring six people to do three things, I can more efficiently decrease my bottom line, tax into my bottom line because of expenses. That's what a business owner would actually do. That doesn't smell good at all to the consumer because the consumer is like, yo, man. So now you ask me to do more work for the same. I mean, more work for the same pay. I need to get paid more.
Pay is going to go up. That's why I said services
What?
or expenses are going to go up.
How is pay going to go up?
Because you have to, unemployment rate is going to come down. If you have to pay for competition, right? So if you run a company, your company is based off the ability of your worker. If your worker, that's why every company wants to hire the best workers, right? For the prices they can afford. When your worker has more options, you have to pay more in order to retain that level of talent. It's the NBA. It's the NFL. You want a good quarterback, you won't pay. Right? In the NFL, why does the cost of the quarterbacks continue to go up? Why in every sport does the cost go up?
Because I'm going to use NFL. The NFL is the most lucrative business model on the planet. They're the most lucrative, right?
And the United States is the most lucrative country on the planet.
I'm rocking with you, but there's a difference between the NFL and McDonald's. McDonald's, what they've done to increase their bottom line is this here. Although McDonald's is very lucrative, they are. Mm-hmm. They're not hiring more people. What they're doing is they're decreasing their staff and making the machine of McDonald's run on machines, not more people.
Yeah, that's a long-term trend. You're right. So let me ask you this: so what if McDonald's demand went up, they wouldn't hire more workers?
I'm rocking with you, but your demand is predicated upon the consumers having a positive response to what the Fed is doing. What I'm saying is that ain't gonna happen.
So what's the history of Fed cuts to the consumer positively impacting the market?
Now, if you're pointing back to history, it's going to lean more on your side. Here's the difference. And I'm using 2007 because it's the nearest history there. In that history, it was only centralized to one industry, real estate. This one is different because it's on every industry. Different contexts.
Well, the market's actually doing good. That's why in the S&P, what did the S&P do this year?
The S&P went up because it was falsified. You know what they did? Now, this is what I mean by these numbers.
It went up because there's more money in the system, and companies were actually maintaining profitability. Partly because, like what you said, debt went up. That debt was used to support the businesses that were going, right, in order to increase that. But once we refi that debt to lower prices, that updates the liquidity in the system, causing more demand, causing the prices to go up. That's why I'm saying 10 to 15% next year.
I'm hearing what you're saying, but if what you're saying is accurate, the company we work would never file for bankruptcy.
Oh no, that's different. You bringing this up now. You bringing this up now.
Hey man, I got receipts, baby. So what I'm saying is this here is if what you say, because I look at the fruits of the entire context of the economy, right?
Yeah, I'm with you.
And so what I'm saying is, if what you're saying is correct, and the market is just going wonderfully well, what I'm saying is, why do consumers have more credit card debt? The economy's doing well. Why borrow more money? Doesn't make any sense.
It's a combination of things. It's a combination of high prices.
Okay.
Like, just think about it. Of course, you'd be tapped if you go.
Sure.
Let's say you want to go buy a car, right?
Mm-hmm.
Well, I'm gonna go buy a car. Car prices are at damn near all-time highs. So now the car that would normally be $25,000 is $35,000.
Yeah.
Because inflation inflated it up. So now it's 35. Then you go to get a loan on it, and your interest rate is 10%.
Yes.
That just makes sense.
So what I'm saying, if what you're saying is actually correct, what I'm saying is having to raise interest rates when it comes to a lender should not ever happen at all, because of the fact that the economy is doing well. You got a question.
It's not going. It's going well for the situation we're in.
So it's like you said in the previous live. Well, at least we're not in a recession. That's what you said before. It's not. At least we're not in a recession. We'll talk. We really are, y'all. We're really in a recession. Let's stop the count. We really are.
It's the game. What I'm talking about is the game. Like now are we in a real good fiscal spot? Nah, not really. Right?
There we go.
But we're in a manipulated system. And since we're in a manipulated system,
talk to the people.
We gotta play the game the way the rules are.
Gotta play the game.
You know what I'm saying?
I got you.
So if I share my screen right now, right?
Go ahead and share the screen if you need to.
And I go in right here.
There we go. We got you, baby.
This is 1 year, right?
Sure enough.
How much did the market go up?
24.23%.
In 1 year, 25. And so if you would have followed the S&P, you would have made 24% return.
Gotcha.
You started getting the real estate return numbers now. That's phenomenal return. That's not even average. That's not even good. That's phenomenal return.
We on one, baby. I'm rocking with you, Cliff. Here's my question to you, Big Dot, for the folk in the back row. Are the masses actually doing this type of stuff?
No, this is mostly the top 1%.
So Cliff, what you are prescribing is what the elite do. What I'm saying is, does this plan work for the non-elite, so to speak, the middle class? Does this plan work well for them? And if so, why are they not doing it?
The middle class is based on unemployment primarily. If you're an employee, you're in the best position when you can get another job.
I agree.
That's the best position you get in.
I agree.
So you can't be in that position unless your company and the company that wants you are both lucrative, and there's money flowing. They got money to spend.
I agree.
So where do they get that money from? Where do they get that money from? From the 1% who just made a 25% return, who are investing in those companies to continue growth.
But Cliff, I got to go back to this. If what you saying is right, big dog, why are the middle class borrowing more on their credit cards? Shouldn't this 24% be flowing to them?
Not while interest rates are high.
So to make sure we understand this, so we don't have a booming economy at all. It's sucking pretty badly, right?
Oh no, what I'm showing you, the stock market of what it's doing is a predictor, right? I've said this before.
So this ain't happened yet.
It's about 6 months ahead of time, right?
So this hadn't happened yet.
You get into the stock market hoping that it goes up.
I'll rock it with you.
Because you're saying, hey, it's almost like, hey, I expect whatever president you like, I expect them to win. If they win, stock market will go up. Well, would you buy it the day they get elected, or would you buy it 6 months before they're elected?
Rock with you. I rock with you.
Right.
I rock with you.
I'm using this as a predictor. Right now, the market is stagnant. things are not going real well. But they
agree.
will go well in the future when they cut interest rates. If you knew that, you'd be buying. That's why the market in the last month was up 5%, because the people in the know understand I buy now so that I know in 4 months, 5 months, when they cut, the market's going to jump. I get my returns.
Yep. Now, and that's cool here. And I like that she brought this up. This is the Wife School podcast, 6 months before. And so what she's saying is that the consumers have to wait for 6 months to potentially get this type of return. Now, in that 6 month time frame, how much damage will this cause them for waiting?
Oh yeah, that's why I said I agree with you. Between
Okay.
now and the first cut, that is going to be the worst. That's going to be a tough period.
That's going to be very tough.
The next 3 to 4 months are going to be tough before they do the first interest rate cut. But the back half of 2024 is going to be much better.
It's going to be for now. Whoo, guys!
I know.
You guys have let us know that you like these type of talks that me and Cliff actually have when it comes to the economy. That's why we kind of parked it a little bit and actually had a good discussion. We've been on this thing for about good 40 minutes, but it's been a good, healthy discussion. Now guys, we're not going to leave you without no counter move. Come on, y'all. This is a real estate live training. We have the real estate investing counter move. So even in case what Cliff is prescribing doesn't happen, we got you, baby. We got you. So Cliff, I'm gonna ask you a series of questions. I'm gonna bring up the calculator, right? And Cliff, guys, has flipped. Cliff, how many homes have you flipped in over the years?
Man, I've probably been involved with them like 50.
50?
50 plus, something like that.
50 plus? That's a lot of flips, y'all. That's a lot of flips. Now, guys, and that's him actually being very, 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 very humble. It's been more than that. There's been more than that. He's been killing it. All right. So now let's dive this real quick. Cliff, let's use real simple numbers, guys. We're gonna walk you through, guys, this right here. How to guarantee funding for your deal. Let me say it again for the folk in the back row. How to guarantee funding for your deal, whether it be multifamily or single family. So get your pens and pads out, guys, and write down this sauce. Because you're going to get a master flipper and also a private equity lender walking through these numbers. All right, Cliff? So, Cliff, let's look at these numbers real quickly, all right? So let's just say, for instance, Cliff, let's use simple numbers. $100,000 is the ARV, right? Let's say the purchase price of said property, guys, is, let's say it's $30,000, right? That is the sales price, right? ARV is $100,000. Let's just say, for instance, the scope of work budget is $25,000, right? If the ARV is $100,000, Cliff, and the property is on sale for $30,000, right? And the scope of work is $25,000 to get it up to par, right? So you get the $100,000. What price point do you want to buy this property at if they're asking $30,000 for it?
I mean, it all depends on the type of property, what you're trying to do, but I mean, at the highest, you never want to go before probably 70% minus repairs. That's the most that you'd want to pay for a property.
So basically, what you're saying is $100,000, right? It's the ARV times 70%. You want to say your all in is 70,000, right?
Yeah, that's the most. That's the most you want to be all in.
Gotcha. So let's walk through these numbers. So if the sales price is $30,000, Cliff, would you buy it for $30,000, or would you want a decreased price point?
I want a decrease. I want lower.
Gotcha. So again, guys, write this down. $100,000 is the ARV. Cliff is saying he wants to be all in, worst case scenario, 70% of the after repair value, which in this example is $70,000. So if $30,000 is the sales price, Cliff, in this market, what price point do you think a seller would actually agree to on a property that he wants $30,000 for?
What do I think the seller would want?
Yeah, hypothetically.
I mean, they probably want the 30 they trying to sell it for.
Okay, so let's get $30,000. You want $30,000. Now watch this. Typically, lenders, guys, would actually fund about 85% of the purchase price, right? There may be some minimums coming in, but they'll do 85% of the purchase price. So that'll be $30,000 times 85%. Boom. That means my loan amount that I'm getting from the lender is $25,500, right? Now, Cliff, the rental budget was $25K, right?
Right.
So a lender would give you 85% of the purchase price, which is $25,500, and we'll give you a 100% of the renovation budget. The renovation budget is $25,000. So what you'll do is you'll do $25,500 plus $25,000, right? Your all in is $50,500, right? Cliff, if the ARV was $100,000, right? You said you want to be 70% in, all in, worst case scenario, right?
Right.
$50,500, I know dumb questions, is lower than $70,000, right?
Right. Yeah.
So from your standpoint, good deal or bad deal?
Yeah, that's a great deal.
Great deal. That's how you guarantee, guys, that you actually get your deal funded. Cliff gave you the sauce. He's saying, I want to be 70% all in, worst case scenario. Of course, lower than 70% is even better, as we see here, right? But 70% is the worst case scenario, knowing that I'll get 85% of the purchase price and 100% of the renovation budget from my lender. Right? Now, let's look at the numbers. If you're all in at $50,500, right? Remember, guys, Cliff, if the ARV is $100,000, right? At what percentage will you be refinanced out post renovation?
About 80%.
80%, is that cash out refi, or is that
cash
rate
out was
return?
probably about 75.
75%, right? Boom. That means $75,000. How much were we all in, Cliff?
55.
$50,500 will be all in.
Yeah.
Oh, my bad. My bad. $75,000. Here we go. Minus $50,500. That means your profit is $24,500. That's really not your profit. Because remember, guys, you got to bring a down payment, right? Down payment. So really, if you look at it, guys, let's look at this. Look at this here. Really, your all in is $30,000, right? Minus $25,500. That is $4,500. Remember that amount. Remember, $75,000, right? Minus $50,500. Right? Yes, you're all in. Right? That's $24,500 minus your down payment. Because you want to get that, but you want to get that back as well. Boom. You've made a profit of $20,000 total, non-tax, because you refinanced out. So I think it's wise to conclude, guys, that when it comes to that 70% all in, that's actually pretty cool. Now, Cliff, on a apartment complex, do you still do 70% all in?
You might want a little bit more space. You might want 65%.
There we go. So all you would do is all the $100,000, guys, right? Times 65%. Now that's $65,000. Same numbers. You just lowering the LTV of what you want to be all in. And if we still go through those numbers, it's still a good deal. Still a good deal. That's how you guarantee funding of your deal, is knowing your numbers. That's it. Most investors drop the ball here. They don't know their numbers. We were on a real estate master class, Cliff, right? And we had one gentleman, good guy, brought us a deal in a certain state. And what happened was, on that deal, Cliff, he wanted to buy the property for a certain amount of price point. We said, okay. Cliff asked him one question: what's your scope of work? He said, $15,000. And Cliff was like, what are you gonna do with $15,000? I'm gonna replace the walls. This. Cliff's like, $15,000 on the page for maybe carpet and paint. That's not gonna work. So you better know your scope of work, or your scope of work numbers as well, also. And guys, the numbers that I went through, guys, is an actual deal that we did already now. That's a real deal. Those numbers are real. Not theory, but I wanted to show you how Cliff and I look at numbers so we can know in seconds exactly if it's a good deal or not. Am I right, Cliff? I'm off.
Yeah, I mean, we always got to work the numbers, man. If you're going to invest, if you're going to play this game, you just got to recognize that it's a numbers game. It's all about the numbers. See, that's why Dale's using a calculator, because at the end of the day, that's what it comes down to.
It's real simple, guys. It's just remember this here, guys. Just remember this. Cliff said for a single family residence or an SFR, right? He wants to be 70% all in, worst case scenario, knowing that his lender is going to give him 85% of the purchase price and 100% of the renovation budget. Okay? Now, for a multifamily or apartment complex, all Cliff does is he lowers it from 70% to 65%. Same metrics, same lending LTV, same everything. Now, the only difference is when you go to refinance on the multifamily, you're probably at 70% versus 75%. Do you see the difference? It's the 5% markdown. It's all it is. Very simple to do. So we're telling this guy, so when you come to either myself or to another lender, that you ain't looking stupid and crazy. Would that be right, Cliff, or wrong?
Yeah, I mean, you just want to have your stuff together. You know, whenever you go and you talk to a bank, you talk to whoever you need to. You want to have all the documentation. You want to have basically the fundamentals of the deal, right?
That's it, guys. Again, SFR, 70% all in, knowing that I can get 85% of the purchase price, 100% of the renovation budget, with the refinancing LTV of 75%. I know it's a lot of percentage. Write it down. Okay? And if it's multifamily, just adjust everything down 5%. That's it. That's simple.
And I see the Wife School podcast. I see you out there saying you're not good with numbers. Get you a calculator. Get you a basic. They have all kind of fix and flip calculators out there. They got all kind of them. Hit us up. We can send you one. It's real simple once you understand how to use it. You put the numbers in, boom, does all the math for you.
Done. That simple, guys. That simple. And so it's just, guys, it's we want to end 2023, guys, on showing you how you can guarantee, right? How you can guarantee, this is real, guys, how to guarantee funding for your deal. Real simple. I hope this is helpful for everybody. Because I know, Cliff, did we get taught this, man, or did we have to learn this on our own?
Oh no, man. I had to learn this on my own. I mean, it took me months just to get what Dale just said. It took me months. I'm talking about meeting after meeting, investor after investor. Nobody put me on game. I had to learn from hard knocks, do it myself.
Exactly. No, not a problem with it at all. The Wife School podcast, no problem with it at all. It's just, guys, we know. Cliff, let's end it with this, man. What deals do you see coming in 2024? We talk a lot about the economy. What deals do you see coming in 2024? What do you see coming?
I see the probably it's probably gonna be properties with the ability to have some appreciation to them. Like I would say mid-tier, a lot of those properties that you see around 400,000, those ones are gonna be hard to find. You find 3-2s about 15 to 2,000 square feet. Mm-hmm. They're not gonna have huge equity. You're gonna have decent equity.
Yeah.
But what's gonna happen is those properties are all gonna go up. My projection 25%, 30% in the next 3 years.
He's right, guys. It's real simple. It's not hard. It's real simple, guys. He's spot on. I ain't gonna say, I'm gonna say amen to that. He's right. He's spot on, guys. This is why it's in pivotal. Know your numbers. If you don't understand these numbers, rewatch this again. Just fast forward to this section and walk through this again. If you need more help, DM me and Cliff, right? Or write it in the comment section. It's real simple, guys. That makes some sense. It's real simple. Know your numbers. Know them. If you need help walking through the numbers of a deal, DM us. We respond. It's not an AI bot. It's us. We respond. It's us. So, well, man, that's all I have for today, Cliff. Man, you want to say anything, man, before we chime off for 2023?
No, man, it's been a good year. In some ways, it's been bad in others. But hey, man, we still getting at it. We got a lot of opportunity coming in 2024. And this is what I'm gonna say. For 2024, y'all out there who ain't bought a house, buy a house. Get you one. Learn the process. Get you a cheap one. They have houses for $20,000. Ask us how we know. You know what I'm saying? Ask us how we know.
We know.
Just try to make a deal. Make something happen. I'm telling you, you'd be amazed how one deal, I've seen Dale pulling 6 figures off a house. You know what I mean? I've had a couple flips over 50K. You know what I mean? So you can go out there, you can do it. You just got to be able to take that first step and get things moving across the board. So yeah, just do what you got to do. Get that first deal through, man. 2024, man. I'm looking forward to it.
I agree with Cliff, guys. There is paralysis by analysis. It's too many people, and I was speaking to a friend of mine that he has a great credit profile. I mean, great money manager, knows what he's doing, but he's afraid to pull the trigger. And I'm like, bro, why are you on the sidelines for, man? Get active in the market. Become proactive. Most investors, guys, are not proactive. Become proactive, guys. I agree with Cliff. Go out there and buy your first. If you need help, we're here. That's why we have the cash flow club. So we have that. And so you have access to us and on-demand training. All right? It's very simple to do, guys. On-demand training. So that's why we do monthly master classes, guys. So in 2024, me and Cliff, we're automating our system to where it's just automated. Automated, because right now, speed is the new currency for us. Go as fast as possible. Speed. Those investors that can move fast and make decisions quickly are going to capitalize on so many opportunities. Am I right, Cliff? Am I wrong?
Oh man, 100%. Because the deals, the thing that happens is, put it this way: deals equal speed.
Yes.
Because if you take a house that you're in right now and it say, Dale, you put on the market 50% off.
Yeah.
The first person to email you saying I'll pay all cash is going to be the one who probably gets it. So it's all about speed.
Gotcha. It is about speed. And I'll give you one last example, guys, and then we'll be done. If it wasn't for our team, we had under contract a pretty big, I would say pretty big, a medium-sized apartment complex in a city. Upside's crazy. Numbers were ridiculous. I mean, the numbers, the afterpay value was what? Was 1.9, between 1.7 and 1.9? It was ridiculous. And we were buying it for, are we talking about like 10 cents on the dollar? But the scope of work, and we had a pretty big scope of work. Here was the problem, guys, is we asked the question, why is this property on the market for so long? And it wasn't for our team members that were like, LaDale, our architect, he came back and said, guys, you may need to knock this down and rebuild it from scratch. We said, wait a minute. So that changed a lot. So now what we did was we said, you know what, let's go ahead and put out the deal right up front, and then let's see if it stays on the market. Guys, that same transaction, Cliff, is still on the market.
Yep. Actually, they dropped the price.
And they dropped the price. Now we coming back in. Now we probably come back in, guys, and get it for a lot cheaper than we had it under contract. Now it makes more sense for us. Right, Cliff, am I wrong?
Yeah. Because when I see, man, you don't have to build. But if you did build, I think the problem was when we was looking at it is we were looking at it from an apartment standpoint.
Yes.
versus a row of houses or townhomes. I don't know, but it was a good deal that we may have to pivot on, because that's what happens when you do in real estate. You got to pivot.
Guys, be okay with walking away from a deal. Be okay. It's better for you to lose your earnest money, $500 or $1,000, than for you to get locked in the deal and now you SOL.
Yeah.
For us, we say, you know what? Let's go ahead and give them the $1,000. That's all good. Let's drop in the bucket. We all good. Let's get it in. Let's get it in. But guys, man, that's all I have for this. Half what I had, guys. You know how we ended every single time, guys. Before you leave them while you can, you see that thing, guys. Take that damn picture and give it to your mom and them, guys. We see you next year, guys. Stay blessed, stay safe, and holler at your partners. All right, y'all. Peace.
God give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.